Hi everybody, good Wednesday morning. We're on the floor of the New York Stock Exchange with Jim Cramer to break down today's market action. All right, Jim, we got a hot inflation report, a drop in retail sales. What did you think?
Well, okay, so January retail sales are unimportant because post-Christmas, my father sold gift wrap for a living. We lived through the January month where there's no holiday, there's nothing. So retail sales, just take it off the table, not an important number. Don't start thinking stagflation. Is the CPI hotter than we like? Yes, it's medical, but we know we can't get control of that, hence what Bezos is doing. It's also rents. Well, obviously we're trying to build as many houses as we can, but there's just some very severe zoning restrictions. And the other stuff I think is all explicable. Gasoline's obviously been coming down pretty furiously here. You can't have both a gasoline bull market and an oil bear market, which is suddenly what we got into. So I think that what happens is people say, you know what, that's the number why we sold off. Now we combine that with wage inflation, and we recognize that Powell may have to hike 4 times, that it's a precarious moment for Powell, so let's sell stocks. Against that was a collapse of the VIX, and the VIX was clearly the tail that's been wagging the dog, because even though interest rates went up, say 13 ticks, it wasn't enough to be able to trump the collapse of the VIX, which is what this sell-off has been became after the initial 2.6 to 2.9 interest rate decline, meaning the prices went down, rates went up. So when you want to be sophisticated about this, what you can say is, wait a second, rates are going up a little bit. Obviously, they're not skyrocketing like they would have, say, in 1988 or 1997. There are a lot of people who want to be really granular. We interviewed Jan Hatzius from Goldman. He was talking about the idea that you had to go into the second digits, no longer 2.7, now it's at 2.78. Obviously, all these things to me are a little gratuitous, and what does matter are the earnings. There are opportunities abounding. I would just give you PepsiCo today. It's an actual name. 2 people downgraded. I went over that quarter over and over and over again, fine-tooth comb. It's really clear that that Frito-Lay's kicking butt. These guys were obviously setting up, I think, for a Coca-Cola upgrade on Friday. I mention this only because we have companies that report good numbers, and there's a lot of scrutiny, and then we have inflation data, and we got to overlay them both. And it turns out that what matters is, unless it's a downgrade, that the VIX is playing a major role. So the reason why the market can rally is because the VIX declined, not because of interest rates. VIX trumps interest rates. Say it after me. VIX trumps interest rates.
And you brought up Pepsi. You'll have more on Pepsi in your Action Alerts Plus call today at 11:30. That's right after this. Meanwhile, Jim, Chipotle with a new CEO, the CEO of Taco Bell.
Yeah, I mean, I was reading the ingredients to my colleague David Faber about what a beef burrito has at Chipotle versus a beef burrito at Taco Bell, and the Taco Bell the list is about 5 times longer, and it's all the stuff that we regard as being unnatural and inorganic. And it's what, if you were a part of the ethos and revolution of Montgomery L's Chipotle, what you would have found is it's completely antithetical, if not existential crisis, versus what Chipotle has. I would warn people that this is going to be, you may like it if you're a shareholder, but if you worked at Chipotle, you'd be like, are you kidding me? Isn't this our mortal enemy? So they take the mortal enemy guy who's very good at efficiency, very good at supply chain, very good at advertising, and they overlay him on the natural, organic, non-franchisable, slow growth Chipotle. This is Emmanuel Velikovsky. This is when worlds collide.
You write about that in Real Money this morning. Also, Jim, Fossil, shares up 60-something%.
Wearables, wearables, wearables. The numbers that they gave you for wearables would make it so that you felt like you should buy Apple off it. There was amazing. When you have this kind of whipsaw futures nonsense, Apple was up 2, then Apple was down 2. If you dealt with the fundamentals and you overlay Fossil, which is, I like to do these things, you see that there's going to be a gigantic increase in wearables, and Apple is the dominant wearable. Fossil had a 44% short interest, betting that they would go under. They clearly are not going under. Secondary read-through is through Michael Kors, which has come down and is doing very, very well. So the wearable category is big. That helps Apple, particularly for those who say that all Apple is this and not a recurring revenue stream and not anything involving what I would say is non-cell, whether it be the tablet, whether it be the PC. So this idea that wearables might be worth something is a little, doesn't fit the narrative of negativity for Apple, and I say that beware of the negativity for Apple given where it is versus the charts, which are going to play a role.
Okay, Jim, that's it for us for right now. We're going to continue the conversation, and we hope everyone tunes in at 11:30 for your Action Alerts Plus call.